Today's business analysis is brought to you by They Might Be Accountants. We empower people. Linda Jackson and Taylor Johnson, owners of Humble Pies Incorporated. All of us here at TMBA are delighted to have the opportunity to recommend to you an equipment investment option we believe is worth your while. Our team has spent countless hours assessing these opportunities. First, we want to discuss each of the two investment options, how each option would affect Humble Pie's profitability, and what the return on investment would be. Next, we will discuss the strategic, technical, and risk factors that were relevant to our decision. We are confident our recommendation will ensure a financially stable future for you. To begin, let us introduce ourselves.
I'm Ethan Sutton, and here at TMBA we work to make your company better.
I'm Trent Mickey, and I help provide solutions for your business.
I'm Randy Cardis, and we're committed to helping your business succeed. In order to compute the gross profit over the entire investment, we've taken additional sales per year multiplied by the gross profit margin. That gives us just about $70,000 per year. Multiplied by 3 years gives us just about $212,000. We must now find the cost of the investment. The initial investment, $500,000, divided by 10-year useful life, $50,000 per year. Now that we have everything we need to determine the return on investment, we've done just that. Before taxes, 41.75%. After taxes, 28%. This is a profitable investment. However, we need to consider other options.
Investment option 2 involved a $500,000 investment in a label-making machine that was meant to prevent the bottlenecking problem we'd seen in labeling in the past. Using this investment, we would see a $13,000 increase in monthly revenue, along with a savings of $14,500 in labor every month. Using the income statement we received from May of 2014, we were able to use the percentage of sales method to forecast our production costs over a year's time. We then included the 20% increase in these production costs that would come with this $500,000 investment, and saw that after the increase in these costs, even with the increased labor savings and revenue, the increased costs would outweigh the increased revenue by a large margin, meaning we would not recommend investment option 2 as an option for Humble Pies.
We also analyzed an option that you brought forth to us in your first meeting, an option that would increase capacity by $500,000 in sales per month for a $500,000 investment in ovens, mixers, and other preparation equipment. Now, from our previous discussion, 60% of your sales would come from the holiday season, which equates to $1.8 million in sales for each of these 3 months, based on the $9.3 million sales projection for this year. However, these months are limited to a production capacity of $1 million. The remaining $6.3 million is then allocated out over the other 9 months. Now, we assign the exact figure to May as it was given to us in the previous financial statements, and the rest was just separated out evenly over the remaining months. That additional $1.5 million in sales per year, applying the same gross profit percentage we calculated from the previous financial statements, would generate an additional gross profit of $135,000 per year. However, we must also first take out the expense that would be generated through this investment, an expense of $50,000 a year in depreciation. This coming from the $500,000 investment being amortized over a 10-year useful life. Then, taking out this $50,000, our final additional gross profit with the investment would be $85,000 per year. Option 3, or the additional investment in $500,000 of mixers and ovens and other preparation equipment, would generate the highest return for your initial investment. And therefore, that is why we recommend this option to you.
We'd now like to discuss some technical factors of investment option 3. Investment option number 3 improves working capacity. In conjunction with our cost allocation framework that we developed in our first proposal, we can identify inefficiencies in operations and fix them to lower cost, so that our 9% gross profit margin would be a conservative estimate. As costs will be reduced, we can expect profits to rise, resulting in a higher return on investment. We can then strive to obtain the goal of 15% gross profit margin you would like as indicated in investment option number 1. We just have to go about it in a different way.
Our team then wanted to consider the strategic factors that would go into an investment decision. Currently, Humble Pies Incorporated does most of their sales in the fourth quarter and are limited by the capacity of the plant. By increasing capacity of the plant, these 3 months could then generate greater profits that then could be turned around and used in the company in different ways. Currently, Humble Pies Incorporated only utilizes word-of-mouth advertising. By taking these additional profits and investing them in sort of marketing or advertising campaign, the other 9 months where Humble Pies is not selling at capacity of the plant, those sales could be increased and therefore generate further revenue. Additionally, the increased capacity would better prepare Humble Pies Incorporated for its future vision of taking the company to a national level.
So regarding risk factors, with any additional capital investment, fixed costs increase, resulting in higher vulnerability to market declines. Volatility in the baked goods industry in recent years has been considerably higher due to trends in health and wellness, making thorough evaluation of investments an important step. With more capacity comes more risk, but more opportunity.